studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
As we move further into dividend planning, it is important to understand that not all dividends are treated the same for tax purposes. In Canada, corporations generally deal with two major categories of dividends: eligible dividends and ineligible dividends. The first thing to understand is that both are dividends. In both cases, the corporation is distributing profits to shareholders. However, the tax treatment can be different, which is why the distinction matters. In the center of the slide, we see a business owner standing at a fork in the road. This represents a common planning question. Should the corporation pay an eligible dividend or an ineligible dividend? On the left side is the eligible dividend path. Eligible dividends are generally associated with income that has already been taxed at higher corporate tax rates. Because of this, the tax system often provides a more favorable dividend tax credit to the shareholder receiving the dividend. On the right side is the ineligible dividend path. Ineligible dividends are commonly associated with income that benefited from lower corporate tax rates, such as income eligible for the small business deduction. As a result, the dividend tax credit available to shareholders is different. The important point is that the tax system attempts to recognize the level of corporate tax already paid before profits are distributed to shareholders. This is one of the reasons why eligible and ineligible dividends exist as separate categories. At this stage, it is not necessary to memorize the technical calculations. What matters is understanding that the two dividend types are not identical and may produce different tax results for shareholders. Many owner-managers assume that a dividend is simply a dividend, but from a tax perspective, the classification of the dividend can be very important. Another important concept is that corporations cannot always choose freely between the two categories. The corporation's tax history, earnings, and available tax attributes often influence which type of dividend can be designated and paid. We will explore those planning considerations in the next slides. For now, the key takeaway is simple. There are two major dividend categories: eligible dividends and ineligible dividends, and they are subject to different tax treatment. Understanding this distinction is the first step toward making informed dividend planning decisions and understanding how dividend distributions may affect both the corporation and its shareholders. Now that we understand there are two different categories of dividends, the next question is why that distinction matters. The answer is simple. The type of dividend received can affect the shareholder's personal tax outcome. This slide compares eligible dividends and ineligible dividends from the shareholder's perspective. On the left side, we see the eligible dividend. When a shareholder receives an eligible dividend, the tax system generally provides an enhanced dividend tax credit. This reflects the fact that the underlying corporate income has often been subject to higher corporate tax rates before being distributed. Because of this enhanced credit, eligible dividends can sometimes result in a lower personal tax burden compared with an equivalent ineligible dividend. The exact outcome depends on the individual's province, income level, and overall tax situation. But the general concept is that eligible dividends often receive more favorable tax treatment. On the right side, we see the ineligible dividend. Ineligible dividends typically receive a different dividend tax credit. These dividends are commonly associated with income that benefited from lower corporate tax rates, such as income eligible for the small business deduction. As a result, the personal tax treatment may differ, and in many situations the shareholder may pay more personal tax on an ineligible dividend than on an equivalent eligible dividend. The key point is illustrated by the calculator in the center of the slide. Two shareholders could receive exactly the same cash amount, but the tax result may not be identical if the dividends are classified differently. For example, one shareholder might receive an eligible dividend while another receives an ineligible dividend. Even though both receive the same dollar amount, the amount they ultimately keep after taxes may be different. This is why dividend classification becomes an important part of tax planning. The decision affects not only the corporation, but also the shareholder, who will report the dividend on their personal tax return. However, it is important not to oversimplify the issue. Eligible dividends are not automatically better in every situation, and ineligible dividends are not automatically worse. Tax outcomes depend on many factors, including income levels, province of residence, and other personal tax considerations. The primary lesson is that dividend type matters because it influences how the dividend is taxed at the personal level. The key takeaway from this slide is that two dividends with the same cash value can produce different after-tax results. Understanding whether a dividend is designated as eligible or ineligible is an important part of understanding the shareholder's ultimate tax position and making informed dividend planning decisions. After learning about the tax differences between eligible and ineligible dividends, the next logical question is whether a corporation can simply choose whichever dividend type produces the best tax result. In practice, the answer is often no. The type of dividend that can be paid is frequently influenced by the corporation's tax attributes, earnings history, and various tax accounts maintained within the corporate tax system. The process begins when the corporation earns income. As profits are generated, those profits are taxed within the corporation. Depending on the nature of the income and the tax rates that apply, different tax attributes may accumulate over time. This is where the accountant plays a critical role. Before a dividend is declared, the corporation's tax balances and accounts should be reviewed. These accounts help determine what type of dividend may be available for designation. As shown in the center of the slide, the corporation may have access to various tax pools and corporate tax accounts. These tax attributes form part of the framework used to determine whether an eligible dividend can be designated or whether an ineligible dividend is more appropriate. In other words, the corporation's tax history helps shape the dividend decision. Once the available options have been reviewed, the corporation formally designates the dividend. This designation is not simply an informal choice. It is an important step that should be properly documented through corporate records and dividend declarations. The board of directors typically approves the dividend and records the appropriate designation as part of the corporation's documentation process. After the dividend has been declared and designated, it must be reported correctly to the shareholder. This reporting generally appears on the shareholder's T5 slip and is used when preparing the personal income tax return. Proper reporting is important because the tax treatment of the dividend depends on its classification. An incorrect designation or reporting error can create unnecessary complications and potentially lead to problems during a review by the Canada Revenue Agency. Notice the discussion taking place between the owner-manager and the accountant on the right side of the slide. This reflects a very common real-world question. Can we pay an eligible dividend? The answer often depends on the corporation's tax accounts and supporting calculations, rather than simply the owner's preference. That is why experienced advisors regularly review corporate tax balances, confirm dividend designations before payment, maintain complete documentation, and ensure that all reporting requirements are satisfied. The key takeaway from this slide is that the corporation's tax attributes often drive the dividend decision. Eligible dividends are not available simply because they are preferred. The corporation must have the necessary tax attributes and supporting accounts that allow the dividend to be properly designated and reported under the tax rules.